Good afternoon, everybody. Thank you very much for attending the Macarthur Minerals webinar. Today we are obviously focused on the discussion of the recent press releases. Macarthur's put out on the resource update, the feasibility study. We have today with us from Macarthur, Ken McCall, Chairman, Joe Phillips, Director, I guess some of the face of the company, and Andrew Breton, which is current CEO. I'm going to hand the ball over to Joe, because I'm not sure if Joe's on yet. Okay, I'm going to hand, I think Cameron, maybe I'll hand the ball over to you to say a few words, but the real focus here is to provide an update on what's happened. Obviously, quite a bit, very material has happened. We're very excited about the company, what we've seen come out, where the company's going, etc. So, Cameron, maybe I'll hand this over to you, Cameron. You can say a few words and then, again, focus on the update, really on the resource and feasibility, and kind of update the people with us today on kind of what's happening and where we're going. You're on mute. Cameron, you're on mute.
There we go. Yeah, look, I'll start. I'm not sure if Joe and Andrew are on yet. I was actually going to take you down a walk down memory lane to how this all started and my involvement. This company it started in the iron ore business. If you go back to 2005, when the Phillips family, that was Joe and his father Alan, actually had the iron ore tenements. They had negotiated that with the old original prospector, a fellow by the name of Mel Della Costa. They were looking for a listed vehicle to progress the development, and they approached the late Ken Talbot, and Ken had this company, Macarthur Minerals. I believe the legacy issue was it had been listed in Australia, then it was listed in Canada. At this point, it was listed in Canada, and that is how it ended up in Canada. Between 2005 and 2009, the company progressed, but not at the speed that the Phillips actually would like it to have progressed. So in 2009, a group of us, being Joe and Alan and some others, including myself, we actually bought out Ken Talbot. And in 2009, Alan Phillips became the chairman of the company. The company progressed, and Joe will certainly talk a little bit about memory lane. He'll take us through the 2010, 2012, and I think it's very important, and that will bring us to where we are today. And Andrew will explain the differences as why, because in 2012 this was going to be a 10 million tonne development. It's now 3 million tonnes. There's very good reasons for that, for economics and ease of financing and how that gets going. But we bought out Ken. The company's progressed to 2012. The 2012 PFS was done. By 2014, iron ore was falling, and it fell all the way to $38. So we basically mothballed the project, dusted it off in 2017. In the meantime, the company pivoted towards some lithium and gold assets, which we've now spun out into Infinity Mining, and that's going very well. Joe now chairs that company. So that's the history, a bit of history of where we are. This feasibility study that we've done now is a real milestone for the company, because it puts us in a position where financing can be done easily. Yes, we are in talks with strategic partners. Obviously, there's a lot of confidentiality around that to progress this. And we've always said that this project needs a strategic partner in there to get it into production. There's no secret about that. But I'd like to hand over to Joe now to talk about his involvement all the way through, and then he can hand over to Andrew, who will walk you through the feasibility.
Thanks, Cameron. Can people hear me? Is that coming through?
Yep, I got you, Joe.
Yeah, right. Yep. Look, thanks very much. Look, it's been a bit of a walk down memory lane for me. As I said, I go back all the way to 2006, 2007, when we first put our series of holes in. Look, Macarthur's come a long way. I pulled out a slide from the 2010 PDAC conference we attended, and had a look at where the project was in 2010. That was 12 years ago, and we've certainly advanced through the stages. And interestingly enough, in the early days, magnetite was the focus. I mean, we were looking for a big tonnage, plus billion-ton resource, and in late 2009, 2010, we actually achieved that. The interesting thing about the project economics is it's very similar to what it is today. I mean, I had a look at the mass pull figures, and I had a look at the grades, the average grades, and I had a look at the process flow sheets that we designed back then for our initial pre-feasibility. For our initial scoping study, and it's not dissimilar. The difference is, and Cameron pointed it out, was in those days we were going for the big 10 million tonne, and the capital cost was pushing $2.5 billion direct and indirect. So that was sort of certainly out of the money. We've taken a lead from Champion Iron. I think Champion's been a good one for us. They started like we did. They started off with a big project and the big capital spend. And they've had a couple of false starts, but now it's going from strength to strength. And they did that by starting with 3 million tonnes a year and building up based upon cash flows after you pay back your capital. And that's our strategy. It's really simple stuff. Get a capital stack that's digestible and fundable via debt and strategic partners, and pay your capital back. And then after that, what you've got is you've got a mine that can go on into perpetuity, generating cash flow for its shareholders. So look, that's Macarthur. 3 points I want to make. First is we have the right project. We have an ore body that's over 7 kilometres long. It's continuous. It doesn't break. It's very amenable to open pit. We've done some study in pit design. I think there's a bit more work to be done on that yet, to be totally frank. And that's Andrew's job, moving forward in the value engineering stage. We have the right people. Over the time, I handpicked the people that have worked on this study, Andrew Bruton and Dr. Dean Carter, and I did it because they were the men for the job. Andrew's got an extensive history in relation to port and rail infrastructure in Australia. He was the driving force between multi-access users on the east coast of Australia for major coal ports. That sort of experience you can't buy off the shelf. Andrew and I have worked together for over a decade, and I really respected what he was doing. And at the right time in Macarthur's history, I reached out and said, you need to really come and put that skill to a commercial test for your own. He's the CEO driving that forward. And Dean Carter, Dean's been with us 11 years. I remember Dean when he first started, and he started off doing our environmental work. He knows the project he knows every tree on the claim. He knows the project from the ground up, and that's a real privilege to have a person who's been that dedicated to an outcome. And we have the right partners. Look, a few years ago, I went across and we did a deal with Glencore in relation to our offtake. Some loved it, some hated it. Look, at the end of the day, Glencore's the right partner. They're the world's largest iron ore trading company. They were the forerunners in picking up magnetite ore as the new pathway to global transition to low carbon future. Look, they're not a front runner. They said that, they told me that up front. They said, we'll be there all the way through. And when we did our Australian listing, Glencore certainly was front and centre in relation to assisting us getting, transitioning part of our investor base into the Australian market. So look, Glencore's there. As you know, we've had Richard Moon positioned in Korea now for some time. Look, he's been promoting. Look, investors from Asian countries don't just walk around and write you a check. They want to see the project evolve. They want to see that we're committed to an outcome as much as we want them to commit to us. So he's been there for 2 years. He's been promoting the opportunity that Macarthur offers, both in relation to strategic partners in construction, in equipment supply, and in steel manufacturing. We provide an opportunity for a steel mill in Asia to get a generational supply of iron ore. And, when you've got 1 billion tonnes plus resource, that's what you can claim. The interesting thing for me is back in 2006-07, we were pioneers. No one was really looking at a long-term future in iron ore in the Yilgarn region. Now every major is looking at that region as an opportunity for a magnetite hub. Every major iron ore producer is seeking a position. So we're in good company. Let's look at the facts. 3 million tonne a year. That gets us going. We got a 4-year payback. We've still got the hematite that stands alone, which we can exploit once we've got our route to market sorted out. And once our infrastructure is in place, it still stands there. It's not going anywhere. The feasibility outputs will be subject to some value engineering over the course of the next 6 to 12 months. As I said, it's got a digestible capital stack. We've got a project payback period of 4 years. And look, for investors, once the capital's paid back, look at the cash flows that this project generates. I mean, it's very valuable. Look, the Australian market gets it. There's no doubt about that because it understands iron ore. The Canadian market, well, I mean, you've got 1 or 2 producers, and you've taken a read from that. But the Australian market is very heavy in iron ore producers, and they have been marking us up well, which hasn't been the case in the Canadian market. But anyway, look, let's try to remedy that. I'll hand over to Andrew now, and he's going to talk about the key outputs from the feasibility and also the next steps forward. Some news and some value accretive steps that Macarthur will take in relation to driving value for shareholders in the Canadian market. So with that, I'll hand over to Andrew to give you some detail. Andrew.
Thanks very much, Joe. Can everybody hear me? Hopefully I'm there.
Yep, you're there, Andrew. You're right.
Great. Thanks very much. Yeah, thanks, Joe. Thanks, Neil, and thanks, Cameron and Joe. Look, I'm pleased we've got the opportunity to speak with you today, and obviously we're grateful to Neil and InvestorCube and Stella and Dennis for organising it. Joe and Cameron have given you a good overview of the company and its history until now, and they've also shared some of their insights. I'd like to talk to you a little bit about where we've come to in the last couple of weeks, but more importantly, where we're going to from here, and how we're going to get there. I'll just, I don't know whether I'm sharing my screen or not, but I'll see if I can remedy that. But look, we've come out in the last couple of weeks with 2 very major announcements to the market that are the culmination of a lot of work from Macarthur and its a result of a lot of years of exploration and analysis work, which Joe and Cameron have alluded to. And it's achieving something that few explorers managed to do, and that's to get the opportunity to develop a mine. So this has actually been a momentous week for the company. And so I want to talk about the announcements and unpack them for you a little bit today. But before I do that, I want to address a couple of matters. The first, I guess, is a little bit of colour around our engagement with the market over the last several months and shareholder expectations. There's no doubt that over the last several months, there's been some challenges on the news flow front. And while we were in the vortex of the study, it was always going to be difficult to keep material news flow out there. There's a lot of very detailed work involved, and that just had to be ploughed through. And frankly, that isn't exciting. And I think we saw the effect of that in the share price over the last several months. We've obviously got a very retail-centric shareholder base at the moment that's hungry for news, and a lot of shareholders have some interest and expectations around disclosure. Clearly, the expectations around the feasibility study have been building for some time, and we needed to give the market some rolling guidance on the delivery schedule. Complex studies like these take time. They don't always run to schedule, especially during the challenges of a global pandemic, but the results are out there now, and I think that we're going to create new levels. Having said that, the start of this week saw a little confusion, I think, on the two markets. There was some disparity between the share price responses we've received on the Canadian and Australian markets, and I think Joe alluded to that a second ago. I think a lot of that had to do with some positioning going across on the TSXV in particular, but I also think the market was waiting for some further colour on the feasibility study and the project generally, and so that's what this forum's about. And we'll be increasing our messaging around this over the course of the next several weeks as the market digests those outputs. Now, in an ideal world, we would have been able to message all of this to the market in a more orderly way with the release of the feasibility study outputs on Monday, but we had a bit of a curious turn of events last week, which caused us to really accelerate our timeline for delivery of those outputs this week. And the reason was simply put down to exchange compliance requirements here in Australia. We went out earlier than planned on the timing for the release of the outputs, and that probably surprised some people in the Canadian market in particular. As you know, companies generally have 45 days to release a technical report to the market after the mineral reserve statement, but the ASX took a different interpretation over here in Australia. It's not one that we agree with, and there's certainly plenty of precedents to the contrary, but look, we had to release the key feasibility study outputs contemporaneously with the ore reserve statement here in Australia, and as a consequence, we needed to balance that information disclosure on both exchanges quite rapidly. We couldn't have a situation with the two exchanges or two markets trading on different information. Look, in the end, I think that getting the study outputs out into the market's been a good thing, and the market can now take the time to digest all of that properly and in context, and you and investors can rest assured that the company's got a strategy around the next stages of funding and project execution that'll keep the project on track and moving forward. But before I step through the feasibility study, I think it's important to remind ourselves why we're all really here. Joe touched on it briefly. We're here because we all understand the potential of investing in a company that's got a lot of high-grade magnetite in its portfolio. And Macarthur's got 1.2 billion tonnes of magnetite as a resource. It's huge. And we focused on developing that resource because we understood the structural shift that's going on in the global steel industry and what's happening with the thematic around decarbonising the global economy. And what I want to unpack that idea a little bit before I explain the detail of the feasibility study and its results, because it's important to understand why the project that's been defined by this study looks the way that it does. I want investors to understand why we've designed it the way we have and what's driving those decisions. And in order to understand that, we need to take a little bit of a step back for the benefit of the Canadian market in particular. And some of you will recall that the company put out a technical report in 2019 that was a preliminary economic assessment report that was undertaken to a pre-feasibility study level. And that examined the development of a scenario for a mine at Lake Giles. And given what's been happening to the forward trajectory of global iron ore and steel markets, the company moved away from that project that was defined in 2019. For those of you who accessed that report a while back, that report was a totally different project in terms of scope. Right? It was a combined 3 million tonne per annum magnetite and hematite blend operation. And the most fundamental point to understand is that the current feasibility study is for a 100% magnetite concentrate project. So it's a full 33% bigger on magnetite processing than the study scope that was undertaken in 2019. It doesn't factor any hematite into the end product at all. Now, that's a big difference that's critical to understand. And I think it's something that the market, especially the Canadian market and analysts, need to get across very, very clearly. The decision to upsize to 100% magnetite's driven a lot of project scope changes, and so it's not at all appropriate to compare those two studies. So I would say to everyone in Canada, put the 2019 PEA completely to the side. Yes, we leveraged off some of the work undertaken in it, but it's just not relevant to the strategy that we're now moving forward with. And for the reasons I've just outlined, it's useless to try and compare the outputs of that report to the current feasibility study. Going 100% on magnetite production instead of a blend is part of the company's strategy to focus on the type of high-grade iron ore product that's going to meet emerging net zero thematics for steel production in the coming decades. And with the widening premium gap for magnetite and high-grade ores being baked into the market, we believe it's a smart move for a new iron ore company like Macarthur. So it was a deliberate strategic decision by the company, as Joe pointed out. Some people might be asking, is this uptick in interest in magnetite just another bubble? And, I've been in the mining game for several decades. Joe mentioned before, I've done a lot of important rail work, but my background is broader than that. It's in mining, hard rock and other areas. It's in energy, renewable energy, base load power station development. There's a whole host of skills I bring to this project. And I've seen my fair share of commodity bubbles, but the really interesting thing about the magnetite story at the moment is the pull that's associated with it. Magnetite projects have been around for years and some have faced challenges. Joe talked before about the magic 10 million tonne per annum level that a lot of companies thought needed to be the benchmark years ago. But they were all pushing the high-grade story to the market. This time around, the current cycle is different. There's a definite pull that's happening. And why do I say that? Well, it's being pulled by changes to global emissions regulations, by policy changes, by the sheer momentum of the global transition towards hydrogen and renewables. And it's all of those things that are leading towards the transition to green steel. And you've only got to think back sort of 12 months ago, we're a light years ahead in terms of the number of hydrogen projects looking to come online at scale. That's being led by companies like FMG and others. At the same time, we're seeing moves by major steel producers to shift their portfolio to a higher grade, lower emissions feedstock as well. So the pace of change has been massive on both of those fronts in a very, very short period of time. And Macarthur's sitting in the box seat. We're more advanced than most magnetite projects out there. But the really interesting thing in the local market over the last 4 to 6 months has been how quickly the majors, as Joe said, in Western Australia and specifically in our own Yilgarn region in particular, have started suddenly waking up to the need to get magnetite into their portfolio. The Yilgarn region where we're located within the last 4 to 6 months has started a process of change where it's now emerging to what I believe and what Joe alluded to before will eventually become a major magnetite hub. And why is that? What's changed that dynamic since Q4 last year, and why is it a genuine change and not a speculative one in my view? Well, there's a number of things that have occurred which, when you look at them all together, make it clear that the shift is on. Firstly, and this isn't new, the impact that declining average product grade is having is important. The average grades of iron ore being produced by the major iron ore producers globally has been slipping in recent years, and it's going to continue to decline. So with cost pressures on existing operations and the high cost of bringing new projects online, tapping high-grade ore is going to be a key to profitability. It's a fact that as prices decline and the steep premiums that the high-grade fines and lumps and concentrate are now garnering and look set to garner into the future, they're going to bolster and improve declining margins. And there's clear evidence of that thinking in the current market right now, right in the very region that we intend to operate. FMG, look, they're hedging with a $3.5 billion magnetite play. Their decision to bring online the 22 million tonne per annum Iron Bridge project in Western Australia, that provides very clear market evidence of a shift of thinking. They've recognised they need to bring their average product grade into their portfolio above 60% iron if they're going to be able to mitigate against price volatility at the lower end of the market. Similarly, you've got Mineral Resources examining a magnetite play now. They suffered a 48% discount to the average 62% price in the September quarter last year. Now, that demonstrated very, very clearly the impact of the deep discounts that steel producers are making on low-grade ore. And what's MRL done in response to that? Well, their last quarterly exploration activities report foreshadowed that their activities at Koolyanobbing in the Yilgarn region, which is very, very close to our project at Lake Giles, as many of you know, it's going to include a resource extension drilling program along with a series of holes testing for the potential for economic magnetite. They've clearly announced that. Now, in my view, that's probably 5 years away at best, and that's if they get moving now. Gina Reinhardt's Atlas Iron took a 30% stake in the junior miner Legacy Iron that's to our north late last year to get access to Legacy's magnetite access. That project's a long way behind us. It hasn't been through pre-feasibility study level studies yet. So Atlas are dipping their toe in the water as well. The other issue that's at the front and centre of all of this is the need to ensure reduced ESG risks. Iron ore miners that can prove that their product is green and can reduce emissions in the mining process, they're also expected to become premium suppliers for steel makers that want to reduce ESG in their supply chain. So what I foresee there is actually a symbiosis occurring in some sections of the market, which is something that we may be able to take advantage of. And lastly, you don't get much more backup than when your own offtake partner gets the joke. In Glencore's 2050 commitment that they put out last year, they announced a commitment to reduce their total emissions footprint, that's scope 1, 2 and 3 emissions, by 40% to 2035 on 2019 levels. And it's got an ambition of achieving net zero emissions footprints across their businesses by 2050. So it's clear that increasing the proportion of high-grade magnetite in Glencore's trading portfolio fits with that commitment. And in fact, I speak with Glencore frequently in Switzerland, and as recently as on the back of the release of recently as this week, when we announced our feasibility study outputs, they've already been fielding inquiries about access to our product from customers who want it yesterday. So it's definitely sparked interest, and there's definitely a market for what we have to offer. So on the supply side, the shift is clear, and it's all in response to changes being driven in global demand. On the demand side, we're starting to see material movement as well. I've said it many times before in presentations, and it's underpinned by work that's been done by McKinsey and others. And it's the simple fact that steel producers stand to lose as much as 14% of their value over the coming decades if they don't change the way that they produce steel. They needed to decarbonise. They simply need to decarbonise their production of steel. In July last year, we saw the first green steel produced in Sweden by Hybrid last month. Last year. Last month, China's Baowu Steel, which is the largest steel producer in China, they announced that they expect to commission their first zero-carbon electric arc furnace steel mill in the second half of 2023. In addition to that, they've also begun construction of a hydrogen-based shaft furnace in Guangdong province in China. ArcelorMittal, another large global steel producer, is also participating in an integrated renewable and competitive hydrogen hub in Spain. So they're part of a consortium that plans to produce and purchase about 7 million tonnes of renewable hydrogen over a 20-year period to produce decarbonised products. ArcelorMittal are also moving further down the pathway on hydrogen and EAF in other projects. And look, there's a host of others, including GFG Alliance and others looking to go down that EAF and hydrogen path as well. So consumer preferences are undoubtedly going to drive product demand, and that's going to inform the production choices that raw material manufacturers make, and ultimately what products the bulk minerals producers and miners like us process. So steel demand is definitely being shaped by what can only be described, I think, as a very concerted move by big industrials to mandate green product procurement supply chains. So green audit trials are being pushed back as far as they can reach, and big European car manufacturers, for example, like Volvo and Mercedes-Benz, they've all confirmed that their procurement strategies are going to include green steel, and they're making a move to carbon-free value chains across their businesses. So the structural shift to magnetite's on. It's definitely real this time. Magnetite is definitely a thing, and we're sitting on top of 1.2 billion tonnes of it. And it's all of that thinking that's formed our strategy here and ultimately the scope of the Lake Giles project. So with regard to the feasibility study, which is, I guess, sort of the main point of today, I think most people have questions about the study, the scope of the project that it defines, and some of the assumptions underpinning it. More importantly, I think that you'll all have questions about what it means for the Lake Giles Iron project and for the company moving forward. So I want to spend a little bit of time unpacking that for you this evening. The key outputs were set out in news releases last week and earlier this week. So let me give you a bit of colour on that. We announced a maiden mineral reserve last week, totaling 237 million tonnes of iron ore in the proven and probable classifications. The mineral reserve contains 74 million dry metric tonnes of iron ore concentrate, and that's based on 87% of the indicated and measured mineral resources. So we have an economically mineable resource, which, as I said, has been the end result of many years of detailed and patient resource exploration work, and Joe and others have had invested a lot of time and effort into that over the course of that period. We then released our definitive feasibility study outputs for the project earlier this week, and so we now have a feasibility study that successfully demonstrates a positive project NPV and a strong forward free cash flow arc under the assumptions that we've adopted. Now, in terms of the study outputs, what does that involve? Well, as Joe mentioned before, the study has defined a project that will produce 3 million tonnes per annum of high-grade, low-impurity magnetite concentrate, and it's going to produce it consistently for a 25-year life of mine. That product's going to be a 66.1% magnetite concentrate, and of course, because of that, it's going to attract a grade and a magnetite premium, a grade premium and a magnetite premium over and above the 62% benchmark price. In looking at the structure of the project, we had to balance capital and operating costs as we undertook trade-off analyses to arrive at what we considered to be the most optimised mix at this point in time. Well, sorry, Stella's just told me my camera is off. I don't know whether people really want to see me, but I don't know whether I can turn that back on. It's not allowing me to do it. For some reason, it's not allowing me to turn that on. I apologise for that.
Well, they can look at me, Andrew.
They can look at you instead. I'm just seeing if I can turn the camera on. There's some technical glitch here. I apologise for that, but look, you've got a better chance of looking at Joe than you do at me. Apologies, I'm not able to do the camera at this point. So we had an optimised mix that we arrived at, and look, there's plenty of opportunity for us to look at further optimisation during the project execution phase, and that's exactly what we'll be doing. As far as operating costs are concerned, look, the operating costs for the project were based on live contractor rates and in-house estimates, and the processing and crushing costs that were developed by our engineering consultants, they were based on feasibility study level engineering and processing plant for the processing plant and the supporting infrastructure. The project's going to have a total C1 operating cost of $71, just under $72 a tonne US. And that's exclusive of Western Australian state royalties. And look, the breakdown of that is quite simple. Our mining costs are coming in these are all in US dollar figures at about $26 a tonne, crushing and processing about $22.40, logistics at $21.25, and general admin at $2. So that gets us to our C1 cost. Capital, the project's going to have an initial construction capital cost of $569 million US. Excluding capitalisation of the overburden sustaining capital. Now, that's obviously a healthy capital number in anyone's language, but it's not out of order for magnetite projects. It's about $189 US per 1 million tonne of annualised output. And the difference with the overall capital figure reported in 2019 is basically linked to the 33% increase in magnetite processing volume. I think that the easiest way to put that capital figure into perspective for the market is to look at other magnetite projects in Australia, and obviously the most recognisable one at the moment is FMG's Ironbridge project, which is targeting 22 million tonne per annum of output, and it's coming in on cost at north of $3.5 billion at the moment or thereabouts. Now that equates to about 160 to 170 million in capital per 1 million tonne of concentrate output annualised. So Macarthur's comes in a little bit above that, but we don't have the benefit of the Ironbridge scale, which is a massive project. Even at 3 million tonne per annum, we're sitting reasonably close to the FMG project on that measure, which for a new mining company in the magnetite space is reasonable. And that's before we look at any further project re-optimisation in the lead up to production. I think you could also bear in mind Grange Resources released a re-optimised pre-feasibility study earlier this week for its South Downs magnetite project with a 5 million tonne per annum operation. They were originally looking at a 10 million tonne per annum operation with a well north of $2 billion price tag associated with it. They've reduced that down by halving the cost of the output to around $1.4 billion on capex, and that places their capital cost per 1 million tonne of output at around just under 200 million, about 197 million US. So I don't think it's in many respects sort of helpful to make direct comparisons between projects on too many measures because each project is different. But I think there's been some questions over the capital figures, and I think that what we've achieved at feasibility study level as opposed to pre-feasibility study level like the Grange project, that delivers a very respectable outcome. The other thing to remember, the last point I'll make on construction capital, is that all of this was priced at the height of the iron ore market and COVID. So there's some normalisation issues that will come into play here as well. I think that's an important issue to take into account. All up, the base case assumptions for the project can deliver a pre-tax NPV of $579 million US, a pre-tax IRR of 13%, and a post-tax NPV of $443 million US. We've adopted a range of different discount rates under the project, sort of right through from 6% to through to 10%. We're using 6% as our base case, but we're still very positive on an 8% NPV. We've undertaken a detailed analysis of where the mining projects are sitting in terms of risk profile in the current market over the last 18 months. Obviously gold projects are sitting at or below 5% in the main, but they're a bit different and we're not going that low. But at this stage of the project, when we have a study that's been de-risked beyond pre-feasibility study stage and with a fair bit of engineering work done, the expectations are different. We're getting views from our financial advisors and groups that we're talking to, and we think adopting a 6% discount rate as our base case at the moment is appropriate in the current market. The iron ore price that we're adopting for the study was based on our assessment of published consensus pricing. We also got forecasts derived directly from direct contact with quite a number of steel mills. We used analyst reports, published analyst reports, and of course we used a comparison of historical analyst forecast against actual pricing over time. So we've adopted a sales price for our high-grade magnetite concentrate, a 66.1% magnetite concentrate of $131.40 a tonne. And that's based on a forecast pricing for the 62% benchmark price through to 2050 below $100 US a tonne. Now, the product is going to get obviously a premium for grade, and you're seeing a widening premium between 62 and 65%, generally about 20 to 25%, and we believe that premium gap is going to remain and get baked in, but most likely improve over the next period, precisely because of the sorts of issues I spoke about before in terms of the changing dynamic around global emissions and net zero. And of course, there'll be a magnetite premium on top of that. The project payback period, Jay said, we'll be paying that back. We expect within sort of 4 to 5 years. And post capital repayment, the company's going to be looking to fund an expansion of the project via cash flows. We don't have an intention to stop at 3 million tonne per annum if the case for it looks profitable beyond that, and after we get through capital payback. And I think that's the champion iron playbook. We want to walk before we can run, but we've got 1.2 billion tonnes of product there. So if we can expand and we can get economies of scale over time in an expansion environment, we're certainly going to do that. So what does all that mean? Well, look, it means that we have a go-forward position on the project that we can now take to market. Now that we've completed this work, I'd say that whilst there's still work to be done before we get product over a ship rail, the completion of this work really places us in the category of being the most technically advanced magnetite project in the Yilgarn region of WA at the moment. So subject to securing project finance, we're really set to be a first mover in the region. So what's the plan going forward? What are our next steps? Well, look, 2021 was a really busy year for the company. We had the feasibility study in full swing. Infinity Mining IPO was underway and got completed. And of course, we had an early revenue DSO strategy for a large part of the year that was being pursued on the back of market expectations that were, I guess, being driven by supernormal iron ore prices at the time. And that was in addition to all of the day-to-day normal things that we needed to do to keep the company functioning and moving forward in a positive direction. But I sat our team down earlier this year in January, and I laid out a very different picture for how I saw Macarthur evolving into 2022. I want to simplify to a singular focus this year. It's going to be no less intense in terms of workload. In fact, it's going to be a much more intense year in many respects. But in 2022, the Lake Giles Iron Project is going to be front and centre. It'll be our sole focus. So what is that going to entail in terms of next steps? It'll involve a number of things, as Joe alluded to before. It'll involve enhancing the project through an additional value engineering phase. It'll run in parallel with the commencement of our project execution schedule. We're going to look at ways to improve key aspects of the project further so that we're the most optimised project that we can. We may look at examining approaches to mining, as Joe mentioned before, to power or processing, to see where we can make some more gains, and that's just a few areas. and that'll be progressed in conjunction with our project execution schedule. On finance, Joe and Cameron have both mentioned that briefly. But the thing that's really going to shift the dial with this project is getting that funding in place. The feasibility study is a huge milestone for the company, but getting the project off the page and out of the ground requires more than that. It requires us to look critically at the conditions of the financing and where the financing will come from. Now, we've always said that we'd be looking for the majority of project financing to be through debt. That still remains the case, and we'd also bring in equity and a strategic partner, perhaps at the project level. Under the right conditions for the company, we can go to loan to production, like Champion Iron did. Funders will want to be comfortable that the project stacks up and that the company itself and its team are going to be good custodians for material financing at that level. It can be done, but equally with the right strategic partners, we can de-risk the project funding even further, and that's what the company's been examining and pursuing in discussions for the last 12 months. I'll talk a little bit more about that in a minute. But we're not chasing billions of dollars here. The funding hurdle is realistic in our view. It takes into account the size and the stage that Macarthur's at. So we're actively pursuing a range of financing alternatives as a part of a layered approach to meet our construction capital requirements. And the delivery of that may in fact be on a stage basis to meet the requirements of the project execution schedule. On the specific issue of strategic partners, we're going to continue our engagement with potentials in Asia, Europe and North America, and also in Australia, with the objective of locking in a quality partners that can help us really take the project forward faster and with improved technical capabilities. Joe mentioned before, Richard Moon's been working diligently in Southeast Asia and Europe, and we've also been examining opportunities originating from North America and Australia. A strategic partner could take the form of an EPC partner, as Joe mentioned, a joint venture partner at the project level, or a strategic offtake partner that's not a trader, such as a steel mill. And we've got some flexibility under that in our arrangements with Glencore. My background as a transactional lawyer in the mining space was all about these types of deals. That's what I did every day of the week for close to 20 years. So I've picked up a few things in that time, and I've seen a few deals go through. And as I said in an interview earlier this week, it's not just about getting a deal over the line with a strategic partner. It's about getting the right deal under the right set of conditions. So that's very critical at this stage of the project. I've seen in my former life too many bad deals done by companies and boards on these types of projects where a lack of experience and foresight leaves the company in the position of being a bit of a bridesmaid. You've got only one chance to get it right. And if you look at what happened, for example, with Jindalby Metals on the Carrara deal, where Jindalby did all the groundwork and engineering, but ended up failing to turn a profit under the joint venture that it struck with Ansteel, they ended up writing off their investment in 2014, and Jindalby was eventually picked up for pennies. So that's not an outcome that's going to occur here. So we're certainly talking with strategics and all those that we've been speaking with. They've been waiting for the feasibility study to be delivered. Those discussions have got a gestation period. They don't happen as fast as an equity raising. And there's a simple reason for that. When you're talking about entering into JVs or deals at a project level or other strategic players, you're talking about putting in place agreements that may need to exist for a number of years into the future and under operating conditions. So you want to get them right in order to preserve and enhance value. Now, I guess on the flip side of that, on the pathway to achieving that, we can't sit back. We have to get on with the process of project delivery, of driving the project forward. Why? Well, because whilst I rate our prospects, and I know Joe and Cameron rate our prospects of getting a good strategic partner on board, you can't have your strategy and your project execution timelines pin to expectations. You have to assume that no one's going to stand beside you until they do. And anything less is just foolhardy, and we don't deal in strategies of hope. So we're going to be moving all of that forward and continue to do that in parallel with our discussions on financing. Let's not forget, there's also a scenario in all of this where shareholders get to hold a slice of the whole game and not just part of it. So we have to think about both possibilities, because both of those eventualities come with different conditional parameters and risks, but equally they come with different payoffs. So I think that's really important to understand, and I'm sure our board will be carefully considering all of those scenarios during the next phase. Port and rail access, I'm getting close to tying up, and then we'll get to some Q&A in a second, but I know there's probably been some questions around what's happening with the port. That's an interesting one. I think it's a positive one at the moment. We're going to do our utmost to work with Southern Ports Authority and other stakeholders on port access. I'm actually very buoyed by the prospects of changes at Esperance Port that look set to open it up to more customers now. and things are going to change significantly in terms of loosening up of bottlenecks there from next year. Under the feasibility study, you may have observed that our base case assumes that we may not need to build much new infrastructure at Esperance Port initially. And that's a result of the changing dynamics of the port and rail utilisation recently, which has been driven by very real expectations of a drop-off in forward utilisation by the port's existing iron ore customer. That being said, as part of the study, we also undertook, as a lot of people know, very detailed engineering design work on a new rail unloading circuit, which will work with the port and other users, and it can be developed if the demand is there. So we're entering a very new landscape with the port now, and in my view, Esperance Port is finally going to become a truly open access port, and new export opportunities are going to emerge there within a very short space of time. It's been said before there, but the time for a single operator to dominate that port is almost over. The future availability and quality of iron ore products presently being shipped through that port don't support the sorts of run rates that we've been seeing over the last 3 years. That's absolutely clear. And that's great news for companies like Macarthur, because we really want to see Esperance Port become a strong port with a great future ahead of it. And the best way for that to occur is to diversify its customer and product base. I'm feeling much more comfortable about the position on the port than I was at this time last year. I think it's now a matter of when we get that through that port, and certainly I believe that access through Esperance Port is going to be assured for our Lake Giles magnetite project. In terms of project execution, I mentioned that before. Obviously we're going to advance our project approvals and commence working through the project execution schedule now. That'll include environmental permitting, covering the impact zone at Lake Giles and along the haul road route to the rail siding, amongst other approvals. Obviously, those approvals needed to be commenced and progressed once we knew where everything was going to be laid out on site. Of course, now that we do, we can move through that. We've obviously already got fully granted mining leases and no native title or cultural heritage issues affecting the project. So we're in an advanced position in regard to other approvals for the project. We'll also be securing water tenure. We'll be advancing work with our partners on site-based power solutions and pushing forward with front engineering design work. So there's a lot to do and a lot to get moving if we're going to keep the schedule now, and it's our intention to move through all of it as quickly as we can, because subject to financing, we want to be on site and starting construction of a mine by around about mid-2024. So look, that's it in a nutshell. Thanks for your patience and letting me run through all of that for you. I'll hand back to Neil, because if we still have time, and I hope we still do have time, I expect there might be some questions which Cameron and Joe and I would be more than happy to take. So thanks, Neil.
No, thank you, Andrew, and Joe, Cameron, thank you. You answered most of the questions, Andrew, because Andrew, were you looking at the questions in the chat? Because it seems like you answered quite a few of the questions, or? I
did look. I saw a couple of questions. I saw one pop up on port access, which I may have answered, but I haven't seen others sort of come through. I saw another one that came up on GSO, but
okay. So I think the real I think the other thing I think you should comment on, Joe and or Cameron, is one of the things I see developing in the global iron ore market is the transition, of course, and Macarthur's well positioned themselves, of course, on the green iron ore. And I actually missed a bit of this because unfortunately I did have a call, but I think it's important to know the premium. When you look at the estimates of the iron ore price, those estimates on prices going forward over the next 3 years, and I look at BMO, I look at Fitch, I look at Credit Suisse, I look at UBS. But when I look at, and Joe, you and I have talked about this, and Andrew, we've talked, and Cameron, the premium that Macarthur will receive selling their product at a high grade, low impurity, because the average investor looks at the 62% FE, which is the benchmark, and that's not a fair price, because Joe and Joe and I, we specifically talked about this. You're going to get a significant premium over that, which obviously will increase your margin if there's your company producing iron ore going forward. And I just think it's important you comment on that green, low impurity, high grade is a big deal to you, right, Joe, from day one, and Andrew and Cameron?
Yeah, look, I'll start off with that. Look, the first thing I'll say is I've been in this for well over a decade, and every analyst gets it wrong. No one picked the slump, no one picks the peak. And if you look And if you look at the contracted grade that the majors get for their 62% product, and it's totally at odds. It's totally at odds with the reality of what the analysts are forecasting. So, let me just say that up front. The other point on pricing is there is a genuine shift away to premium to premium product. You look at Champion Iron, and as I said, I take a read from them on a regular basis. They're looking at not just getting over the 65% benchmark. They're looking at continuing to increase their quality and reducing their silicas to produce a super premium product. And, they're doing that by further processing their concentrates. That option remains available for Macarthur as well. I mean, whilst we can produce a 66.1% product, part of the value engineering solution is looking at ways that we can reduce some of the other deleterious elements that are in our concentrate to make sure that we can produce the highest grade material possible. And I believe there's a real market for the plus 60, 67, 68% concentrates. But, that's down the track. But in pricing, the only comment that I'll make is I read widely the analyst reports. I get them daily. And if you want to cast your mind back to, just look at the production of BHP in relation to its iron ore and divide it by its published tonnes, and you don't get anywhere near what the analysts say is their forecast iron ore price. Andrew?
And thank you, Joe. So, because I see the 10-year average, Andrew, we spoke, Andrew, right? The 10-year average is 140. Andrew, right? Right. The
10-year average for 62% is about $105. The 15-year average is getting closer to about 110. But yeah, look, analysts have never got it right. You get out to a certain point on the forward estimate scale, they all go ultra conservative.
Shaky pen.
They get the case of the shaky pen. They all go ultra conservative. I mean, we're trying to forecast out for a 25-year mine life here. I think the fundamental issue that's not being factored into some analysts' views out there, because you get a range, you get outliers. We get very low estimates. We get estimates that were way above what we're putting into the feasibility study at the moment. But for the main, what we're not seeing in mining company valuations, and it's not just limited to iron ore companies, what we're not seeing in mining company valuations is a valuation methodology that's now pinned to the new normal of net zero. And that's something that is going to be very, very specific to companies like Macarthur, which are focusing very much on producing a product that fits directly into that narrative. We are targeting, green steel, we'll get there. I'm not saying we're going to be, a company that's producing from day one a product for a green steel output. But the gravitation towards high grade to reduce emissions and then eventually get into green steel when hydrogen and green hydrogen in particular become usable at scale. That's where the valuation methodologies at the moment fail. And I think until analysts in the market start getting onto that and factoring it in, it's good buying time for companies like Macarthur, because it's all going to change.
Yeah, well, thank you, Andrew. And last two things, well, I'll let you guys go, is one, Joe, you're right, because BMO, Bank of Montreal, has been one of the forefronts in iron ore, and Joe, you and I spoke to Raheem. He's probably one of the leading, analysts in iron ore worldwide. He's been wrong for 4 years, admitted it. They've been targeting, right, $90 and so on. Well, we hit $240 last year. So they've been wrong for 4 or 5 years. So Joe, you're 100% right. The analyst predictions have been wrong. The averages are much higher. And maybe Andrew, Joe, you can just comment on next steps. So resource update, feasibility, what can we look forward to over the course of next, quarter, next 6 quarters, to expect to see your focus, guys, on what Macarthur's going forward, milestones and next steps are?
Yeah, well, look, I'll start and Andrew can fill in. But look, first thing is the meat and potatoes is going to be the project delivery. And Andrew's got his team focused on that. There's no doubt about that. There's some long lead times associated with bringing this out of the ground. Running in parallel to that will be our financing, and Cameron and Eddie Sugar out of New York, and I've talked to 150 mining institutions over the course of the last 24 months. So they're all waiting for our feasibility. In cohorts with that is Richard Moon and the conversations that he's been having with Asian and European and North American and steel producers as well. So look, we've got a three-pronged approach to our financing, and that's well underway. And it has been for some time. I'm a big believer in early preparation. Thirdly is support. Look, and I'd like to acknowledge Andrew's and I have had great support from the Maritime Union of Australia and from the RTBU, which is the Rail and Transport and Bus Union of West Australia. Now, their interest is not in money, their interest is not in our project. Their interest is in jobs for their members. And since 2018-19, since we've been working with the RTBU and the MUA, they have been working tirelessly on promoting open access to Macarthur minerals through the Esperance port. And I mean, and I've got to take heart, because the Esperance port is an MUA port, and these guys are right behind the delivery of our product across that port facility. So, you know, I'd like to say that. So that's the next milestone for me, is port access. Andrew's got rail access down to the port. Now we've got to get through the port, and he's the right man to do that. And I think that port access will be a third key milestone in relation to the delivery of value for shareholders. People forget that Macarthur's also got some assets in the Pilbara. You know, we've got Strelley's Gorge up there, which is just adjacent to Atlas Iron. That's we've had now since 2018. You know, I mean, I can chip a golf ball. I can chip a golf ball between the sites. That's how close they are. And the resource that they're exploiting at Strelley's Gorge runs straight into our tenement. You know, that's again provides a short-term opportunity for the company to do something with a partner. We've also got and Tambora North was drilled out by Atlas Iron in 2012. I mean, they drilled the top of the ridge. They found a resource there, but at the end of the day, the iron ore price was starting to dip, and they let it slide. So, you know, that sits there as well. And we also have other iron ore assets in the Yilgarn that contain both hematite and magnetite that at this point in time we haven't been advancing. So, you know, the company's well positioned with other projects. And without belaboring the point, with the recent interest in nickel, I'm on site in 2 weeks' time with two interested parties looking at the nickel opportunity. Because as we've told the market, the Lake Giles project is on the last untested major Kembelda climatiite nickel area in West Australia. So, I mean, you know, we've had expressions of nickel throughout the drilling over the years. We've actually hit some sulfides with drilling in it. With nickel in it, nickel where it is today. That actually provides another string to the Macarthur bow. So I'll hand over to Andrew. He might have some closing points. AB?
Sorry, hello, Joe?
Yep, I'm here. Yep. Andrew?
Apologies, I was unmuting. Not only can't I get my camera to work, I can't work out how to work my microphone, but apologies for that. No, I was just saying,
all right,
I think
Joe's better looking.
Yes, yeah, look, you're getting a much better view. I think Joe's covered all of those points particularly well. It is really now about moving through, as I said before, the project execution phase and continuing to drive the project forward. I said before, we can't sit back. Financing is going to be progressing, but we have to get on with that process. If we're going to continue to drive towards the timeframes that we're going to set for ourselves under the project execution schedule to get this thing up and running. So that's going to include moving through those project approvals now, our permitting, securing our arrangements on port and rail, which, as I said, never happens before you get the feasibility study out. But I think I'm very confident now, much more confident in relation to the position on the port because of the material shift that's happening in the region there now. And that's why we've shifted our base case for the time being to utilising some existing infrastructure that's there. So it's all looking very positive. I think we've now moved through, what is a very significant gatepost for this project that's now going to allow us to take this project out to the market and to drive it forward and get it into production.
Yeah, look, I'm excited. I mean, going all the way back to the very beginning, we didn't know we had a resource. We know we've got a resource now. We didn't know we had no rare and endangered species on site, and those baseline studies have been done. All you need to have in a project like this is a stick-nested rat, and it's all over. You'll never get your EPA approvals. So we've done that. We've done trog and steiger fauna studies. We've done, we've done clearances for threatened species. We've done all of the above. Then the local community, Indigenous community, has to come out and do a cultural clearance. I mean, if you've got anything of significance on your site, well, that's the end of your project. Look, we've been through 12 years of fear, and for the first time, we can take a breath. That the project is real. The project hasn't got any major hurdles, and we can now focus on delivery. So for me, I take a lot of solace in the hard work that Andrew and his team have done. In delivering it to this point, and I'm excited about moving forward and getting it out of the ground.
Right, and thank you, Joe. I'm also very impressed between the board, Cameron, the chairman, and Cameron and Joe, really the founder and face. By the way, Joe, on the side note, I'm just impressed how much hair you have, because I figure by now you should be like bald as a cue ball. But besides that, with every great asset, it's also the ability to execute. And so Andrew, Joe, Cameron, it's a solid team, strong board, strong management that's focused to execute on where we're going. And I believe that with Brian Norris. And Joe, you were right, because they've all been wrong. And I've spoken to BMO and I've spoken to Credit Suisse, and they've been blatantly wrong for the last several years. And I think they will be wrong going forward. So I'm very excited to be part of this. And I want to thank Andrew, Cameron, Joe. Joe, you and I have been together a long time, and it's nice to see things.
We started off as young men.
It has been easy, but I think we're there, and I think this is a personal note. I'm somewhat disgusted. The stock is 50, and I think Joey and I talked after all the reports that released came out on the resource that we were both a bit upset, but I can't provide guidance. I'm not a broker. We're not dealers, but I am a bit appalled that the stock is trading at the current level. I think it's certainly something you guys, investors, should talk to your advisors or whoever. But I do believe the upside and the potential for Macarthur is significant. And if you go back to October 2017, look at Champion on at 25 cents, which today is $6-7. But even over the next 6 months, when they're at the very same stage that Macarthur's at, that stock went from 25 cents to $1.50. $1.70, and an institutional firm, as Joe well knows, and Andrew Cameron know, does have a $1.80 target on the stock. And I'm not saying we'll fall Champion, but they're in Quebec, we're in Australia. Our logistics are better, your resource is higher, the grade is higher, and that stock went up 600% over a 4-month period. So I think you guys may want to take a look at Champion, CIA. Go back from, I guess, August, September 2017 to January 2018, and look at exactly the same stage that where Joe, Andrew, and Cameron are. It might be valuable to take a look at that. So on that note, I'll say goodbye to everybody and thank everybody for attending. And Joe, Andrew, Cameron, thank you. Email us your questions, anything you have concerns, and please reach out to us with whatever you need.
All right. Thank you.
Yeah, thank you. Thank you very much. Thank you very much, Neil. And on behalf of the board of Macarthur, I can say Andrew will certainly get the mine built, and the board is laser focused on getting the thing funded and a strategic partner. And a point that you touched on, Champion was about $1.20 when it first started. Its first shipment went out, and it's $7 today. So there's the journey, and we're by no means, and we haven't sent our first shipment out yet. So there's the journey for everyone and the opportunity to get in.
100%. Thank you, Cameron. Thank you, guys. We'll end this now. And again, please reach out to us, questions, whatever you need. We're always here for you.
Thank you. Thanks, guys.
Thank you, guys.
Thanks, everybody.